Most people think financial change happens in a moment, a crash, a headline, a market panic. But the truth is, the biggest shifts in history usually happen quietly at first. And right now, something very interesting is happening beneath the surface of the global economy. Governments are printing more money than ever before. Debt levels are climbing to historic extremes. Currencies are losing purchasing power, slowly, then suddenly. And at the same time, gold and silver are beginning to return to the center of the conversation. Not because people suddenly became obsessed with metals, but because history tends to repeat itself when monetary systems become stressed. And if you understand the pattern, you begin to see why smart money behaves differently long before the public notices. So today we're going to break down the deeper economic patterns behind the gold and silver market shift and why this moment may be more important than most people realize. And if you enjoy understanding how economic cycles really work, make sure to like this video and subscribe to the channel, because these shifts affect every person, whether they follow markets or not. There's a pattern that appears throughout history. It starts when economies grow through debt expansion. At first, debt helps growth. Businesses expand. Consumers spend more. Governments stimulate the economy. Everything feels productive. But eventually, the system becomes dependent on borrowing. And once debt grows faster than income, the pressure begins building underneath the surface. The easiest solution becomes printing more money, lower interest rates, more liquidity, more stimulus. And for a while, it works. Asset prices rise. Markets look strong. People feel wealthier. But there's always a cost. Because when money supply expands faster than real productivity, the purchasing power of money begins to weaken over time. And this is the point where hard assets start becoming attractive again. Not because gold suddenly changed, but because paper money did. That distinction is extremely important. Gold doesn't produce cash flow. It doesn't innovate. It doesn't create technology. Its role is different. Its role is stability when confidence becomes uncertain. And confidence is ultimately what every monetary system depends on. When people trust the system, paper money works well. But when debt rises too fast, when inflation pressures increase, when geopolitical uncertainty grows, societies naturally begin looking for assets that have survived across generations. That's why gold keeps returning throughout history. Different countries, different governments, different centuries, same pattern. And one of the most interesting things happening today is that central banks around the world are buying gold aggressively. Why? Because central banks understand something most people forget. Reserve assets matter most during periods of uncertainty. And historically, gold has played that role repeatedly. But silver is where the story becomes even more interesting, because silver behaves differently. Gold is primarily monetary. Silver is both monetary and industrial. That changes everything. Silver is used in electronics, solar panels, industrial manufacturing, modern technologies. So while gold responds heavily to monetary fear and protection of wealth, silver responds to both monetary demand and industrial demand simultaneously. And historically, silver often lags behind gold in the early stages of major moves. But once momentum builds, silver can become extremely volatile because the market is smaller. Supply constraints matter more, and investor psychology changes quickly. What's fascinating is that many major silver rallies throughout history happen when people suddenly realize the imbalance all at once. Not gradually, suddenly. That's how markets often behave. People ignore trends for long periods until they become impossible to ignore. And human psychology is always the hidden force underneath markets. Fear, greed, confidence, doubt. These emotions create cycles that repeat across generations. That's why studying history matters, because while technology changes, human behavior rarely does. If you go back to the 1970s, you saw inflation surge after years of monetary expansion and economic pressure. Gold exploded higher. Silver followed aggressively, not because metals became magical, but because people were losing confidence in the purchasing power of currency. And every major monetary transition throughout history carries similar characteristics: rising debt, currency pressure, political tension, asset bubbles, then eventually restructuring. Sometimes gradual, sometimes painful, but always cyclical. The dangerous thing is that during the middle of these cycles, people believe the environment is permanent. When markets rise for years, people believe prices only go up. When money is easy, people assume debt doesn't matter. When inflation is low temporarily, people assume stability will last forever, and then reality changes the environment. This is why long-term thinking matters more than short-term predictions. Nobody can predict exact timing consistently, but patterns can still be understood. And today, we're seeing several patterns align simultaneously. Historic debt levels, global monetary uncertainty, shifting geopolitical power, currency concerns, central bank accumulation of hard assets. These are not random signals, they are connected. Now that doesn't automatically mean gold and silver go straight up forever. Markets never move in straight lines. There will be volatility, corrections, fear, overreaction, but the deeper issue is bigger than short-term price movement. The deeper issue is trust in monetary systems during periods of excessive debt. That's the real conversation. Because throughout history, when governments face large debt burdens, there are only a few possible outcomes: higher growth, austerity, default, or currency devaluation. And politically, currency devaluation often becomes the least painful short-term choice, which means hard assets tend to attract attention again. Not immediately, then gradually, then suddenly. And this is why understanding cycles becomes powerful, because wealth often transfers during transitions. The people who recognize structural changes early usually behave differently than the crowd. They focus less on headlines and more on long-term patterns. They understand that economic systems move like pendulums. Periods of stability create excess. Excess creates imbalance. Imbalance creates correction. Correction creates reset, and then the cycle begins again. Right now, gold and silver appear to be signaling that the global system may be entering another important phase of that cycle. Not the end of the world, not collapse tomorrow, but transition. And transitions are where the biggest opportunities and biggest risks often exist. The important thing is not panic, it's perspective. Because fear creates bad decisions, but understanding creates preparation, and preparation has always mattered more than prediction. The people who survive economic transitions best are usually not the people chasing excitement. They're the people who understand risk. That's the real lesson history teaches over and over again. Not certainty, not perfection, adaptation. So whether gold and silver continue rising sharply, consolidate, or become more volatile from here, the deeper message remains the same. The world is changing economically, and when monetary systems begin shifting, hard assets naturally return to the conversation. Not because history repeats perfectly, but because human behavior repeats remarkably well. If you found this analysis valuable, make sure to like this video and subscribe to the channel for more deep breakdowns on markets, economic cycles, wealth preservation, and the hidden patterns shaping the future of the global economy. And I'd love to hear your perspective in the comments. Do you think gold and silver are signaling a bigger economic shift ahead? Or is this just another temporary market cycle? Thanks for watching, and remember, the biggest financial changes usually become obvious only after they've already happened.